Bring in now Renaissance Macro's Jeff deGraaf watches these markets as close as anybody does, certainly internally and the technical side of things. It's good to have you here, man. All right, I don't know how a technician keeps his head straight in looking at a market like this. You tell me.
Well, I mean, I'll be honest with you, Scott, and this has taken 35 years of experience to do this, but I just don't get wrapped up in the narrative. It's hard not to do, but I've learned to do it. And I just look for the consistency of signposts, and a few of those things really fired for us Friday. We got pretty long on Friday, and we were looking for a substantial put-call ratios to start to kick in, and we were getting that triggered. We started seeing what we call negative volatility alerts, which are these standard deviation moves. We had over 50% of the constituents in the S&P there. And that to us is the making of, it's scary for sure, but that's pretty consistent with points where you kind of get to that max stress. And so we had beta, and I think this is probably the most important thing. And we warned clients late last week and early this week that beta in our ranking was in the 0th percentile. In other words, you hadn't seen returns this bad for beta ever in the history of our data. And the last time they were even close was in 2020, where we were coming or in the grips of the COVID crisis. And then in the summer of 2022, which was about a week before the lows. So that just, we sent a message out to clients saying, don't be short beta here. It's going to be really dangerous to be too short beta. So think about what can go right. And clearly that's playing out now. I think there's a lot more to go, frankly, for this. And this can be short covering. And you'll see people talk about it's just short covering and it's not real. Guess what? It always starts out as short covering. So if you use that as a crutch, you're going to get yourself into some trouble. But I think we trade these things back at least to the 200-day moving average. I think it's got some firepower. And even if it's only short covering, it's going to make people sort of question their thesis by the time it's all said and done.
So many things are up so much. What would you lean into further if you really do believe that there's a lot more to go? Your words, certainly not mine.
Yeah, look, if you're tactical, we still think that there's beta. There is a massive convexity to beta right now, and that's going to continue to play itself out on the street. And I think that's got days and weeks to go. So tactically, I think it's beta. If you're looking for trends, and these are global, if you're looking for trends that got oversold but didn't crack the trends, believe it or not, with all this stress in the bond market, all the stress in equities, financials actually have held their own very, very well. So banks, international banks, all those look really, really good and still in long-term bullish uptrends. So if you're more structural, if you're thinking about now to the end of the year, I think financials. If you're thinking now to the end of the month, to end of the quarter, I think beta.
What about rates?
Good question. Short rates are saying the Fed probably comes in. They need to. I think that's probably right. And that's not because of what we're seeing necessarily from the markets itself. But if we look at the data and we look at the trajectory of what's happening, it looks to us like we'll probably have an upside surprise to the unemployment rate and some of the job figures this quarter. That should give the Fed some cover to be able to come in and lower rates. Neil Dutta has 4 rate cuts in our shop. I don't handle the rate cuts, but I would certainly agree with what the market's message is on that, and that there is room for rates to come in. The 10-year yield, a lot of resistance at 440. I know we poked our head through that this morning. We're down below that now, but I think this is actually a pretty good time to get long bonds if you're looking to reallocate portfolios. Certainly out of cash, I think long bonds make some sense here.